Hello, I'm Peter Hurlett from Insight Trading and welcome to this month's short CPD webinar, Hot Topics in Academy Accounts. We've done lots of Academy Accounts courses recently and we're getting the same questions frequently on various aspects of the financial reporting regime. This short session will run through those common questions and how they might be answered. We're going to start off with a broad overview of the requirements for academies for 31st of August 22 year ends and then run through the 5 key areas in a little bit of detail. So, just to remind you initially that academies are highly regulated. This is a list of the various regulations that apply to Companies Act 2006 because they are, of course, companies limited by guarantee. FRS 102, the Charity SORP, the Academy Accounts Direction, and the Academy Trust Handbook. In his June 22 blog, my colleague James Charlton went through the Academy Accounts Direction 21-22 in a little bit of detail and highlighted the key changes compared to previous years. And there's the reporting timetable for 22-23. So the key lines on this table are the bottom 2 lines. So financial statements are due for 31st of August 22 year ends with the ESFA by 31st December 22. And the annual accounts return go live date is October 18th, 22. With a deadline for submission 19th of January 2023. Right, let's look at the first of our common questions. This is all about differentiating between a connected person transaction and a related party transaction, which per the Academy Trust Handbook have got slightly different requirements in terms of the way that they're approached. Related party transaction is broadly defined, and then connected person transaction is a subset of that broader whole. Related party transaction is as defined by FRS 102, and any related party transaction that the trust enters into must be communicated to the ESFA by its portal, the IDAMS portal. That's been the case for the last couple of years now. Not to communicate that transaction to the ESFA through the portal is a breach of the regularity regime. A connected person transaction is more narrow, and for a connected person transaction, the at-cost rules apply. So the supplier can charge no more than cost. There has to be an open book agreement and a statement of assurance from the supplier that no more than cost has been charged. So a more specific and onerous regime and compliance with that regime needs to be disclosed in the notes to the financial statements of the trust. Now, this transaction is a related party transaction, not a connected person transaction, for the simple reason that connected person is defined by the Academy Trust Handbook as a member, a trustee, a close family member of a member or trustee, or a company controlled by any of the above. Because the member of the senior leadership team whose spouse's company transact with the trust is not a trustee, this is a related party transaction without being a connected person transaction. So the regime that will apply, therefore, will be different as a result. Let's just summarize the way that these rules work. Okay, so connected body transactions, no more than cost can be charged. That's who's deemed to be connected. So I mentioned members and trustees and family members and their related organizations. No more than cost can be charged. The other requirements around statement of assurance and open book agreement and compliance with that regime will need to be disclosed in the notes to the trust's financial statements. In terms of related party transactions, yes, that's more broadly defined. And with effect from 2019, all RPTs are reportable to the ESFA in advance using the relevant online form. Okay, let's move on to question 2. This is all about agency principal agreements. We're getting a number of questions about these recently. Here's a good example. A trust enters into an agreement with IT for Learners, which supplies laptops to students. Students place an order direct with IT for Learners. They then pay IT for Learners over 36 months, at which point the laptop becomes theirs. IT for Learners remits a proportion of the revenue to the trust. In the event that a student defaults on payments, the trust must pay IT for Learners instead. Now, where a trust is principal to a transaction, the transaction will wash through its account and, more importantly, will wash through its P&L, its statement of financial activities. Where a trust is not a principal to a transaction, but an agent, there may be no impact at all on the accounts. And if there is an impact, it's more likely balance sheet and less likely SOFA. And the key thing will always be with these situations, is the trust exposed to the risks and rewards associated with the transaction? Or in this case, is the trust quite simply a conduit to get the supplier in touch with the student in the example? Now, it will depend on the actual terms of the agreement, but this to me feels more like we, the trust, are agents rather than principal to the transaction. Therefore, the transaction itself will not wash through the trust's account. You may remember there was an ESFA supplementary bulletin issue last year all about the impact of COVID. And that was saying that when you have these sort of laptop supply arrangements, where the trust has got responsibility for where the laptops are placed, it will be principal to transaction and the amount should wash through the SOFA. Where it's not got any discretion over who gets the laptops, more likely it will be agent. And I would take that principle from last year's supplementary bulletin and apply it here. Now, it will depend on the detail, and it is all about who bears the majority of risks and rewards in the round. In the situation here, per the last sentence, though, the trust has got a potential obligation in the event that the students default. The trust may, from an accounting point of view, despite only being agents, consider the need to make an appropriate provision. They think they're obligated to make payments based on defaults that have occurred. Where they feel those monies can be recouped from the students, they might well have a debtor in respect to the amounts they feel that can be recovered. So there will be an accounting implication, but where the trust is not principal to the transaction, the actual transactions themselves will not wash through the books of the trust. Clearly, on a case-by-case basis, you would need to look at the agreement in detail to work out how you concluded in that regard. Okay, the next question is all about income recognition. And we've had lots of questions over the years on income recognition in relation to academies. Here's one that's cropped up recently. Our academy client is on the SCA scheme, so the School Condition Allocation Scheme for capital income. In their internal management accounts, they defer income until they've spent it. However, we make them adjust each year so that they are recognizing amounts confirmed in respect to the current year, but not future years. Is this right? Now, the answer here may well be no. And it all turns on the fact, of course, that when it comes to charities generally, and academies specifically, when they're recognizing grant income, they've got to recognize it on the performance basis, not on the accruals basis. And of course, the accruals basis means that when you get grant income, you defer it to the balance sheet at the point of receipt, and then bring it back to the SOFA to match up against the related costs in future years. When you apply the performance method, you bring it into the SOFA when you meet the relevant criteria around entitlement, probability of crystallization, and measurability. And the charity SORP prohibits the accrual method and mandates application of the performance method. Now, with this example, I would say where you've had a multi-year capital grant application that's been accepted, and where you're over the line and there's no substantive performance conditions to comply with to qualify for the next year's monies, and the next year's and the next year's, what you will do is bring all that income into the SOFA in that first year and restrict it. In this situation, the firm is quite right to say to the client, they have to bring in amounts confirmed in respect to current years into the SOFA, even though they've not been received. But where you've had amounts confirmed in respect to future years, they would need to be brought in as well. And from the point of view of the client here, from the point of view of the trust here, that might well fly in the face of what they think is logical, but that's absolutely what the charity SORP would have you do. I think from an audit point of view, when it comes to academies, the audit of income is reasonably simple and straightforward to a greater extent, but when it comes to these capital grants, cut-off can be really sticky, and it all turns really on your understanding of the way the charity SORP works and the application of the performance method. This example, I feel, is a great illustration of how much the charity SORP accelerates the income recognition process when the amounts concerned are definitely going to come in based on those criteria of entitlement, probability, and measurability. I've heard the rules on leases are changing. Is that right? Now, from an FRS 102 point of view, no, not in the short term. From an FRS 102 point of view, we still very much have the distinction between operating leases which are off balance sheet and finance leases that are on balance sheet, and that probably will not change for a fair while, probably until at least periods commencing 1 Jan 25, when the next substantial revision of FRS 102 comes into play. However, at an IFRS level, we now have IFRS 16. And IFRS 16 at an IFRS level says that the operating lease, finance lease distinction is no longer made in the lessee's books, and you bring all leases on balance sheet. Now, Academy Trusts do not apply IFRS 16 because they apply UK GAAP, not IFRS. But at the consolidated sector level, there is very much an application of IFRS. It therefore seems possible, if not likely, for 22-23 year ends, trusts will need to submit information to the ESFA as part of the annual account return to allow them to do that adjustment at the group level and take the UK GAAP numbers at trust level and restate them on an IFRS 16 basis. So that's not completely confirmed yet, but do watch this space for next year. It may well be, given that national consolidation at a group level, applying the IFRS rules, there might be a need to provide information in those timescales for 22-23 year ends to allow that to occur, even though at a local level, at a trust level, the UK rules around leases, op lease v finance lease, are still very much in place and are still very much applying. Now, in the academy sector, of course, not only do leases have implications from an accounting point of view, they also have implications from a regularity point of view. And any finance lease which a trust enters into has got to get prior ESFA approval, because that is in substance deemed to be borrowing. Op lease is fine. Finance leases require prior ESFA approval, and not to get that prior approval would be a breach of the regularity regime as per the Academy Trust Handbook. It seems possible that with effect from 1 September 22, rather than that distinction between op leases and finance leases driving the need to get approval from the ESFA, the regime might completely change. And what the ESFA might say is, look, these leases for these categories of assets will not require our approval. These leases for these categories of assets will. And it all kind of reflects the broad move towards IFRS 16, where that op lease finance lease distinction is not being made, coming in and applying at the level of the handbook as well. And this may well form part of the Academy Trust Handbook for 22-23, not yet being published. So do watch this space for that. This particular extract from a weekly update from the ESFA dating back a couple of months now confirms the sort of leases where you'll not require prior ESFA approval if this new regime sticks. Others will. I do think the distinction between op lease and finance lease is often quite a tricky one from a regularity point of view, where perhaps trusts therefore are contemplating leasing new assets. It may be better to leave it until post September 22, and we do get a clearer steer as to how this regime will play out. This might make things easier from a regularity point of view, even though clearly it will be a change compared to where we are with the current regime as it stands. And that particular explanation from the ESFA can be found on the weekly updates via gov.uk. Our last question involves transfers of property assets. A local authority maintained school have been transferred into a MAT during year-end 31st of August 22. The local authority will provide a property valuation, but this won't be available until January 23. Do we have a problem? This seems to be quite a big problem, I think, getting these property valuations in the case not only of a transfer from a local authority to a multi-academy trust of a school, but also situations where you might have an existing smaller multi-academy trust or single academy trust being absorbed by a larger MAT. And when that occurs, what has to happen is the property has to come into the new entity's books at fair value. So debit balance sheet, credit donations with the fair value of the asset being transferred in. We therefore need a valuation at the year end to inform the accounting entries for that period. And this therefore is problematical where the valuation has not been provided until the next following year. Now, it seems that what many are doing here is going with a notional figure, an imperfect figure, if you will, for, in this case, 31st of August 22. And then when the more definitive figure comes through in the following year, making an adjustment. Now, this is, I think, an area where you could probably do with a bit more clarity from the SFA. Sometimes those adjustments take in the form of prior year adjustments, where they're going back and doing a restatement to effectively remedy an error as it arose in a previous year. Sometimes these adjustments take in the form of an in-year adjustment. And the way and place in which those adjustments get presented in the accounts is varying significantly from trust to trust. My personal preference probably would be for a prior year adjustment, because fundamentally at the date of the accounts being signed off, this valuation ought to have been available, and then an update and adjustment to the balance sheet to fixed assets to reflect the more definitive figure at the point that the actual proper valuation is available. Now, there are lots of different ways this is getting presented, and here's one that I saw recently, where the actual subsequent adjustment to the provisional valuation was presented in the accounts as a revaluation. This, I think, is somewhat confusing and not really right. This gives the impression, I think, in the accounts that a policy of revaluation is being applied where it's not. All we've really got to do is actually reflect fair value at the point of the asset coming in, and going forward from there, it will be fair values deemed cost. So I wouldn't put the revaluation into the tangible assets note in that way. I would probably make some reference more to adjustment to provisional fair value calculation. Neither would I, as was the case in this particular instance, show this as an other comprehensive income movement. I would either show that through the statement of change in equity as a prior year adjustment, or if you're going to do an in-year adjustment, show it as an adjustment to the donations line in the SOFA where the transfer would have come in the first place. So if you are doing audits of entities where this is relevant, do think about that quite carefully. Do make sure the presentation is not confusing. But as I say, my general theme here is that I think this is a very relevant issue to many trusts, to many auditors day to day. I think more clarity would be required in this area in an ideal world. Lots of different trusts are dealing with it in different ways in their financial statements. So food for thought, certainly, where it is relevant for those 31st of August 22 year ends. Linked to that, we're also getting asked questions by people who are acting for trusts which are randomly getting DFE valuations going forward, which indicated value is lower than the book value. Do we consider an impairment charge to be required? Well, this is the case. Do we have an obligation to push the client to give us evidence that an impairment write-down should not be required? I think with this one, firms of auditors, I think, are taking a fairly sanguine, fairly pragmatic view. First of all, let's be clear. There's no requirement for ongoing valuations. As I've already alluded to, yes, you're bringing that asset in at fair value, but you're not then marking to market going forward unless you're applying an accounting policy of revaluation. If the value given by the DFE is lower than the current book value, yes, there may be an impairment issue, but in the charity world, impairment normally arises when there's been a loss in service potential of the asset. Either charitable asset cannot do what it was always aiming to do, rather than when, quite simply, the valuation is reduced compared to what it was previously in the accounts. I think for lots of firms, therefore, yes, they're thinking about impairment here, but because the asset can function in the way it always did, these subsequent valuations of the DFE are generally being ignored for accounting purposes. Again, reassuring, I suppose, that's the way a lot of firms are going as far as updated valuations are concerned. Okay, so that's just a quick run through the key requirements for 31st of August 22 year ends. I've run through those 5 commonly asked questions cropping up currently on the Academy's updates. If you've got any queries about the content of this session or any thoughts for future sessions, do drop us a note at inquiries@insight-training.co.uk, and do check out our website for full information on our autumn programme of CPD events. Hope that was useful. Good chatting to you all. Speak to you all again soon. Thank you and goodbye.